You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Thank you for tuning in to the Generational Wealth Through Commercial Real Estate show. We got a really special guest lined up for you today. We're going to be talking about loans and how to find the best loan product. But before we get into the show, if you're watching this for the first time, go ahead and hit the subscribe button. And if you haven't left me a review for the podcast, please leave a review now. This is how I'm able to keep bringing on rockstar guests like I have today. Today's guest is James Eng. He was born and raised in Houston, Texas. He studied finance at the University of Texas at Austin. He has lived in Dallas-Fort Worth since 2006. His background is in risk, sales, and investing at GE Capital, where he underwrote $750 million worth of commercial loans. He's a loan originator now at Old Capital, where he's underwritten $800 million worth of multifamily loans across 125 properties. And he's currently an investor where he invests as a limited partner in over 7,000 units across 25 properties in Texas. James, how you doing today, man?
Great. Thanks for having me on today.
Absolutely, man. I'm excited to have you on the show and talk about, loans. But before we get into that, man, tell us your background of, why you chose to get into real estate.
Yeah, I mean, I sort of fell into it. So I was at GE Capital. I came out of school, University of Texas, and then I went into like a finance rotational program. And they basically every 6 months move you from business to business. So I started in a business in Connecticut, then I went to an IT business in Denver, then I stumbled into a commercial real estate group in Dallas, all as part of GE's rotational program, and I loved it there. And so I went from the finance side of the business to really, that was more the corporate finance. We're looking at the P&L of the business into an underwriting position. And when I was an underwriter, so I started underwriting transactions. As an underwriter, you look at the property, but you also look at the borrower. And I saw that these people who we're loaning money to purchase properties, their balance sheets were better than anybody's balance sheet that I had ever seen.
Right.
When I was growing up, like my dad told me, hey, if you want to be the richest guy or you want to make the most money, you go be a doctor, right? So that's actually why I started as a pre-med guy at UT. And so that's the only path I knew. But then once I started underwriting transactions, saw the balance sheets of these investors, I said, hey, I need to start investing in multifamily. And so in 2015, I started investing in multifamily as a limited partner. So that's really the genesis of it.
Awesome. Well, yeah, I mean, we're definitely going to be talking about loans, the purpose of using leverage, the best leverage to use. But before we jump into that, let me ask you, you also are an investor and you do it passively. How do you, vet your operators that you're going to give your hard-earned money to?
So, I mean, most of the operators that I work with, they usually have to have 3 or 4 deals that already are done. So I want to see that track record. That's probably the first thing. Second thing is I got to go meet them. So I usually like to, do a lunch or dinner, meet with them, and then sort of get on their newsletter, and I want to see some transactions come through from them. And I also like to talk to former investors or current investors of that person, right? Because those people, they get the monthly reports or they don't get the monthly reports, and they can tell you the good or bad. Right. So that's usually how I like to start is number 1, track record. Number 2, I got to meet them in person, get a good feel from them. Number 3, just really talking to current and previous investors of that general partner.
Gotcha. No, that's some good tips. And, track record says everything. Your track record doesn't lie. Just like when I played football, my coach used to always say, film don't lie. Whatever you put on film, that's who you are. So it's the same thing with the numbers, man, and seeing how somebody performs. It makes the exact same correlation. All right, man. So Let's talk about the different kind of loans. Well, like number one, let's talk about the most common loan, and then let's talk about just all the options. So if somebody's looking at an opportunity, they know the type of loan products that they can use.
Yeah, so I would start. I like to think about it as really there's four main types of loans that people can have, and on the edges of them, people usually start with like a recourse bank loan. So a recourse bank loan it can be down at 200,000 all the way up to 20 million, right? That's usually recourse bank loan. That's where people start, and then as people sort of get a little bit bigger, they'll go to Fannie and Freddie. So Fannie and Freddie are sort of right in the middle. Right. I mean, I would say probably 80% of loans right now are right in that Fannie Freddie zone on the multifamily side. And then on the far right, I would say is your non-recourse bridge lending. So that is when a property is not stabilized, but it's over $5 million in loan amount, then you go with a non-recourse bridge. And that's going to be for your more experienced people. So most people will start on sort of the recourse bank side, the smaller loans, probably under 5 million, start there, and then go Fannie and Freddie for the next 2 to 3 deals. And then once they get more experience, they might start doing some of the non-recourse bridge. So that's at a high level what most people do.
Yeah. So at Old Capital, you guys are loan brokers. So what are the benefits of working with a loan broker versus just going out and trying to find the best product yourself?
So let me give you some examples of when, let's say, somebody's first starting, they really have no experience getting a loan. And so they can walk into, 5 different banks. I mean, I think on one of your podcasts, the guy, I think it was a mobile home guy, he was saying, he had to go to 40 different banks to try to get their first loan done. Right. So I've already talked to those 40 banks. And so when you come in and you say, all right, this is my PFS, personal financial statement, this is the deal, this is the property management company, I can already tell you, all right, you've got to change your property management company. You got to add this guy to your sponsorship team. And then when we take that package to the bank, it's approved.
Yeah.
Versus you going to bank number 1 and they say, well, we actually want you to add this guy to sign recourse. You go to bank number 2, hey, can you add this property management guy? And then you go bank number 3. So while you're doing that process, that's time as a general partner that you're taking up from not talking to your equity guys, not out there finding deals. Like the same way that a lot of people will outsource property management companies. That's what I think of in terms of finding the best loan, because we're already doing that. Like you might, as a general partner, you might do 1 loan, maybe 2 loans a year. Like we do 20, 30 loans a month. Right. So we already know, we've already gone through all the vetting for you. So I would say that's probably number 1. Number 2 is just in terms of when different lenders go away. So, I would say probably end of last year, Fannie and Freddie pulled back heavy.
Yeah.
So what I mean by that is they had a cap on the number of transactions they could do. So, third quarter, let's say 2019, they said, hey guys, we're not going to lend anymore. Or they were very selective, Fannie and Freddie. And so all of a sudden, if you only had a Fannie Freddie relationship with one guy, now all of a sudden you're in trouble. Right. Because now you need a recourse bank guy. You need a non-recourse bridge. You need a CMBS guy. You need all these different types of lenders. So that's one example. Second example, I would say right now is right when COVID hit, we saw a lot of banks pull back.
Yep.
So lending was relatively easy, and people, you fog up a mirror, you could get a loan, and because there's so many banks, there's so many bridge lenders out there that debt was easy. And as soon as COVID hit, all those guys pulled back.
Yep.
And so all of a sudden we started getting calls like, hey, we're 10 days away from closing. We've got $300,000, $400,000, $500,000 in earnest money hard. We need to close this loan. Right. And so that's when people call us. We love to be on the front of transactions when you're looking at deals. We'd rather, pick the horse from the beginning versus being the second horse coming in trying to save the day. But we always love the second horse save the day stories. So
yeah, absolutely. No, that makes a lot of sense. I did a podcast on talking about building your rock star team, and having a loan broker on your rock star team is critical for all the reasons you just said.
Yeah, and I mean, a lot of times people will, like when they're looking at a transaction, let's say you're looking at, let's say, a $5 million deal. You send it over to me and say, hey, James, can you look at this and tell me if Fannie and Freddie can do, let's say, 80% loan on it?
Yep.
Like, I'll look at the deal and I might say, hey, we just did a loan across the street, 6 months ago, 12 months ago. It's doing well. Fannie did it. The previous loan on this deal was a Freddie Mac loan. This is I can show you the servicing on that. I can show you, all right, who's the other property managers in that market? Has there been any crime in that market, in that area, on that property? Like all these things that it's very difficult for you to see, but because the number of transactions we're doing, then you see all that. And so you have sort of inside information that, whereas, you're a listing broker, but it's not like where you go out and you're not just going to divulge all this information to the buyer, right? So we're sort of like on the team of the buyer. We want that buyer to make the best decision. Yeah. And if there's risk in the transactions, we want to let them know upfront so they can mitigate it. Yeah. We don't really want to hide it or anything like that.
Yeah. No, that makes a lot of sense. And I think it's very, very key just for the fact that having a second pair of eyes on it before you go into a contract on it that's powerful, man.
Yeah. Especially, pre-COVID, a lot of people were going hard, earnest money, 100 to 500,000. Right now it's probably a little bit less post, but there's still, 50, 100, 200,000 in pursuit costs on some of these larger deals. And you just don't want to get down the road where, your loan ends up not coming through, and it's very difficult. On a single family house, you could probably close all cash and then refi later. Yeah. But on a commercial deal, that's probably not going to happen.
Yeah. And for the listeners, when he say hard, he meaning, that money is becoming non-refundable. So you got to be thinking the right way and have everything lined up if you're going hard with your money. I know I don't like losing money.
Yeah, I think that is a surprise for most people when they're transitioning from single family to multifamily. Yeah. Single family, I was actually surprised. I bought a house last year and they were like, all right, you need to put $500 down. And I was like, all right, that's fine, right? Like I was just, that's just like just to get the loan going on, multifamily deals about 10 to 15,000. Yeah. In terms of application fee and things like that, and to engage an attorney is about another 10 or 15,000. So that's what I was used to. That's the type of stuff that I was used to. So when they told me, $500 to put in the contract, I said, all right, that's fine.
Right. Absolutely, man. So let's go over that spectrum of loans. Most people are going to start. They're going to be most familiar with the local credit unions and banks. So let's look at underwriting and how that kind of broken down.
Yeah. So on that first, if you think about the bank recourse loan on the far, let's say left-hand side, I would say 50% of the underwriting is going to be on you personally, your guarantor team. And then 50% is going to be on the property. Yeah. And the terms on a bank recourse loan are typically shorter terms. So it's 5 years. It'll be, let's say, 4.5% to 5% in today's market. Yep. It'll be maybe 1 year interest only. Then it'll go 20-year AM, 25-year AM, depending on the age of the property. Right. And it's recourse. And so what they want is in terms of the bank, when they start underwriting a deal, what they're going to ask you for is trailing 12 financials, rent roll on the property. And then you personally, they're going to ask for your personal financial statement, and they're going to ask for the last 3 years of tax returns. Yeah. Because they want to see if this property doesn't perform for whatever reason, then can you support it, right? What's our secondary source of support on this debt.
Right.
And so they'll underwrite it, and then they'll get you a term sheet back. And we have seen right now, recourse banks are actually very tight as in they do not want to lend.
Yeah.
And the reason is they have a lot of a recourse bank lender. They don't just do multifamily. They do office, retail, industrial, hotels. They do, business lines of credit. They do all these different types of things. And, multifamily right now is actually doing pretty well in comparison to other property types, in comparison to just your local businesses.
Yeah.
So they're actually very tight. And so a lot of people have sort of, it's instead of doing recourse bank loans, they have transitioned more to Fannie and Freddie. So Fannie and Freddie are sort of the kings right now, because they have sort of their goal, or one of their goals, is to help affordable housing, but then also to provide liquidity to the multifamily financing market. Yeah. And so right now, they are probably the number 1 and 2 in terms of providing that. So let me tell you a little bit about those and how they're different. First, Fannie and Freddie are non-recourse. So what that means is your personal balance sheet is not required, or is not at risk, right? So when we say that is, let's say we go back to the $5 million deal, I give you a $4 million loan. If that property for whatever reason drops to $3 million and you get foreclosed, that $1 million deficit, they could come after you personally on that recourse bank loan. Right. But on Fannie and Freddie, they cannot. So Fannie and Freddie, most of the terms are going to be 5, 7, 10 years. So longer term, it's going to be anywhere from 1 to 3 years interest only. Yep. It's going to be rates right now on Fannie can be in the low 3s. And then Freddie SBL, which is 1 to 7.5 million, that's really in the probably 3.5 to 4.5 range, just depending on what type of prepayment and what market you're in. And then it's you do that the 1 to 3 years interest only, and it's 30-year AM. So it improves your cash flow significantly. When I was at GE, we used to do bridge loans, and we could never win multifamily deals because Fannie and Freddie were so aggressive and the terms were so good. It just was crazy. So that's Fannie and Freddie. You usually need at least probably a year of experience on Fannie and Freddie loans to go in for them. And it usually helps to have, experienced sponsorship team and then a good third-party property manager. So they really don't like someone coming in. It's your first deal, and you're like, I'm going to self-manage this 100-unit deal. Yeah. And Fannie and Freddie are going to tell you, hey, let's get someone who, has their training wheels off and has done this before. So that's what I would say is, so going back to the example of the $4 million loan, even though it is non-recourse, they want people, the sponsorship group, their net worth to be $4 million or higher. And they also want them to have $400,000 in post-close liquidity. So what that means is after the down payment, they want that in cash, savings accounts, checking accounts, marketable securities, non-retirement. So that sponsorship group needs that amount. Yeah. And so a lot of people, when they're first getting started, will sort of pre-qualify their sponsorship group upfront. Yeah. And then once they start, looking at deals, I'll send them a term sheet. Let's say it's for a $10 million loan. I want them pre-qualified before to make sure that they can even qualify for that loan. Yeah. And so sort of putting together, you talked about previous podcasts, putting together your team. Right. And, one of those team members is key principals that are going to sign on the loan with you to hit that net worth and liquidity. Yeah. So that's sort of Fannie and Freddie. The last one is really on the non-recourse bridge. This is really for people who have they've done Fannie, Freddie, they've done recourse bank loans. They probably have like a 2 to 3, 4 year track record. Now they're looking at, maybe a 75% occupied deal, non-stabilized, $10, $15 million. Now they go get non-recourse bridge loan. These are typically 3 years. They'll be on a floating rate and, be interest only for the whole period. And those are when you're coming in, you're really improving the property quickly, in 18, 24 months, and then you're trying to refi or sell the property. And so for newer investors, I would say there's a little bit more risk on a bridge loan, because if you took a bridge loan, let's say in 2018, and now you're trying to, or 2017, now you're trying to refi right now, it's going to be pretty difficult.
Right.
The bridge loan, you got to see a lot of value add very quickly, and you got to execute the business plan. Whereas Fannie and Freddie, you sort of have that longer 5, 7, 10-year horizon. And so you don't have that maturity coming on you really quick.
Yeah. And then maturity, you're talking about the balloon payment.
There's a balloon payment, right? So on single family, you get a 15-year, 30-year, it's fully amortizing, and there's no prepayment.
Yeah.
Whereas on these loans, there'll be a 30-year am on Fannie and Freddie, but 5-year, 7-year, 10-year, you pick the term. It's going to have a balloon payment because you haven't paid down enough principal in that time. Right.
Now, is there like a credit requirement, like, as far as whether it's, the local bank or Freddie or Freddie, like, is there like a minimal score that they need to have?
Yeah, for Fannie and Freddie, they like to have it above 650 on the credit score. Yeah. The local banks, I would say, is probably similar. They're going to run your credit for sure. And then, what they're going to also run is sort of for any litigation, previous bankruptcies, foreclosures. If you had any of those, just disclose it up front and then, explain the situation. As long as it, makes sense and it was a long time ago, right? It's usually okay. It's more if it was recent, then you're going to have a harder time getting a loan. And I mean, one of the things that has come up just in this whole COVID situation is that Fannie and Freddie offered owners forbearance, and forbearance essentially meant you don't have to pay your payment for 3 months. But then, whenever you fill out a loan application, they're going to always ask you, have you ever, taken forbearance? Have you ever, gave them back a property? And so people have to answer yes to those. And you just have to explain the situation. Like, COVID is all we think about now, but 10 years from now, the banker looking at you might say, what was COVID? Right. So you just have to explain that situation. If you had some issues in the past.
Yeah. Now, let's talk about COVID a little bit. Obviously, it's changed by the day, like you mentioned before we started here. But as far as the reserves, I know there's a certain amount of reserves that, PI, TI that needs to go in certain deals. Could you talk on that for a minute?
Yeah, let's try to go high level on it, just because it changes, almost daily, weekly. Right. So in March, when it first came out, essentially Fannie said, we're going to escrow principal and interest for, let's say, 12 months on loans above $6 million. We're going to escrow principal and interest for 12 months.
Yep.
That amount plus 12 months of taxes, plus 12 months of insurance, plus 12 months of replacement reserves.
Wow.
And so what that ended up being was, let's go back to that $4 million. All right, let's go $6 million loan, because over $60 million on Fannie.
Yeah.
That ended up being about 10% of the loan amount.
Wow.
And so all of a sudden, let's say you're doing, a $8 million deal, and you got a $6 million loan, and your original equity requirement was $2 million, right? To close the loan. Now you got to add on $600,000 at close to put up with the lender. And so people who were in acquisitions, let's say you got under contract in February, COVID hit, you sort of just got stuck, right? So January, February, those people got stuck. And then sort of April, May, when deals started getting under contract again, people just sort of built that in. They just said, look, I need a 5% or 10% discount because I got to put this money up. And so that happened. People got a little bit of a discount to put up those reserves. And then Fannie and Freddie got 3 good months. So I would say April, May, June, they got 3 good months of collections, right? So apartments, everybody thought collections were going to fall off a cliff because there were no evictions. You couldn't do anything, but people paid. Stimulus was good. collections were 95% plus. So
Yeah.
Fannie and Freddie said, all right, we are going to take off taxes, insurance, and replacement reserve. Now you only escrow principal and interest.
Yep.
So that essentially dropped it to about 5% of the loan amount. And, Fannie on larger loans, it's about 12 months of PI, principal and interest. On smaller loans under 6 million, it's still 18 months.
Yeah.
And then on the Freddie side, the small loans, they still want 12 months. On the bigger loans, it's about 9 months of principal and interest. Yeah. And so that is still there, but it's a lot more, people are okay with that. They're just going out, raising the money. And it's not, they're getting a little bit of discount on the purchase price maybe. And people understand that this money, it's being put up with the lender usually in 9 to 12 months. Once you start hitting a 125 debt service and show that, then they're going to release that money back to you. Yeah. And some people, the way they're using it is they are right now, just because of COVID, they're not doing a lot of upgrades.
Yeah.
Right. Because rents are essentially flat. They're not getting that upgrade rent. Right. So what they're doing is they're going to put up that money, and then in 9 months or 12 months, when they get that money back, hopefully the market's better, and then they start using that money for upgrades. So they're doing, they're building in some of their rehab into that and using that for future. So it ends up being, it's not affecting their equity raise as much.
Yeah. Yeah. No, that's good to know. And it's good that the money comes back to you, because, you can disperse it, or like you said, most operators, the smart ones, are not doing the renovations now. They're just, putting it off and doing it as the money's released to them. So that makes a lot of sense. So let me ask you, man, obviously you underwrite a crap load of deals every day, every week. What are some things investors should be looking for when they're underwriting to just, number one, get the deal off the table before they dig in too deep in it?
I mean, are you talking more like sort of as a general partner or as a limited partner?
Yeah, let's talk about the limited partner, because there's a lot of people that's probably going to get started initially that way.
Okay, yeah, as a limited partner, I mean, you get limited information. You're a limited partner, you get limited information.
Right.
So you essentially get the slide deck from the general partner.
Yeah.
And you have to look at it. The way I would start is probably look at historicals, okay? And see, all right, what's the income? What's the expenses? And let's figure out what the T12 is. And they should have these sort of in columns for you from the general partner's perspective. And then I want to see, all right, if my NOI is, let's say $500,000 right now, then what are we taking NOI in year one, right? And then year 2, year 3, year 4. And then is that, a function of expenses? It is a function of income. Yep. Most of the time, there's a little bit of cutting of expenses, but most of the time it's really income growth that you should be focused on.
Right.
And you want to see, is this general partner taking income, from below market to at market? All right. Or are we going beyond the market? And so you have to sort of understand what is rents. Let's say in Dallas right now, on like a Class B deal, your rents might be $1,000. Okay. Right. Then if this guy is taking rents from $1,000 to $1,200, what's the rationale there? Are the units larger? Is it a better location? What rent comps are getting from $1,000 to $1,200? How are we getting there? So show me how to get there. Right. And so that's more on the income statement side. And then what are we using? What's the exit? Right? Is usually what I look at second is, all right, what cap rate are we assuming? And if deals are trading, let's say a Class B deal right now maybe is $100,000 to $125,000 on a Class B deal per unit. When we sell this deal, is the exit $200,000? Like, is that realistic? $200,000 a unit? Are we going to sell this deal for $200,000 a unit at a 4.5% or 5% cap? Or does he need to use a residual of 6 to 6.5% on this deal, and we're going to sell it for $140 in 5 years? So that's the $140 sounds good to me, right? Like if I can buy it for $100, take the rent from $1,000 to $1,200 and then we sell it for $130, $140 a unit. That sounds about right to me. So that's really at a high level. There's probably only one deal out of 25 deals that I haven't seen, but mostly every deal I'll just go and drive it, right? And get a feel for it and say, drive, either in the morning or at night, and just drive and see the quality of the product. And on a stabilized deal where the general partner is only putting in maybe $3,000 to $5,000 a door and just doing interior rehabs, like essentially that's your product, right? But if your guy's going in there putting 10 or 15, what you're looking at is probably an ugly baby. And they're coming in and just redoing the whole thing. So it doesn't really matter what it looks like right now. Like the tenant base might not be that great right now. So, in those deals, it's probably not as important, but you always want to see what's the after, right? What's the after of, after I put 10 or 15 a door in it, what's the exit? Is there people achieving those rents in those markets? Because you don't want to be like the shiny palace and, or surrounded by a bunch of bad properties. So, that's from a limited partner standpoint, that's the key things. I mean, you're usually getting, a 10, 20 page slide deck. And those are the key things that you should be looking for on the property. Hopefully you've already done sort of your borrower due diligence, as your, buyer's due diligence, and you already know the general partner and all that. So I'm assuming you've already vetted the sponsor. You're comfortable with them. Now you're really looking at the properties underwriting and getting comfortable with that. And, there's some general partners that I really like, and I said no to deals that they sent me. Right. It's not like just every deal that a general partner sends you, you don't have to invest in every deal. Right. But, pick and choose your spots.
Yeah. Now, when you're saying underwriting, and for the person that's just getting into this, what kind of spreadsheet would you recommend, or, is there a certain model that's out there, just for the general public that people can go to underwrite deals with?
No, there isn't. There's not really. I mean, most limited partners, I don't see them really using Excel that much. It's more of a, get to know the borrower, get to sort of understand the market that they're investing in. And even me, it is hard for me. Like if you sent me a deal in North Carolina, like I don't know that market. Right. And so I'm not going to sit there and be like, all right, why is the rent, 20% higher than market? Like, I don't know that market. So as a limited partner, I think you have to do a little bit of research in the market that you want to invest in. Right. And to me, as a limited partner, I don't take the general partner stuff and model it in Excel and, test all their assumptions and stuff. I mean, I look at it as a high level, and as long as it makes sense in terms of, price per unit, the rent that they're trying to get, the business plan that they're trying to execute, then that's how I get comfortable with it. As a general partner is very different. As a general partner, absolutely, you need an Excel model to sort of put in your rent projections, put in your expenses, put in your rent forecast, put in your cap rate, put in your distributions, put in how much equity you're going to take from the deal or do a preferred return, all that type of stuff. Absolutely. As a general partner, you need that because you're going to run different scenarios. You're going to get quotes from your insurance agent, your property management company, all those types of things that are going to be constantly changing. So you definitely need that. As a limited partner, pretty much, you don't have control over that. So you don't need an Excel to keep changing it. But I mean, I have a basic model that I use for loan sizing, and then an Excel model for just modeling returns at a high level.
Now, just from a limited partner's perspective, from I guess returns based, like how are you typically seeing deals? Is there like a standard way that you see a 70, 30 split or 80-20 split with some waterfalls in it?
I mean, there's two ways really. Most so the ways that sponsors get paid are, number one, they might have an acquisition fee right at close.
Yeah.
Number two, they might take equity in the deal. And that might be a preferred return to limited partners. And then they split maybe 70-30 after that.
Yeah.
Or they might just take 20% of all cash flow in distributions. And then the fourth is they might have like a disposition fee. And then fifth, they might have a asset management fee.
Yeah.
I would say most the standard deals that I'm seeing, acquisition fees, maybe 1%, 2%, depending on the size of the deal.
Yeah.
The equity that people are taking usually is about 20% if they're doing just like a straight split, 80-20 with no preferred.
Yeah.
And then asset management fees usually 1 or 2%. And then disposition fee, most of the time we don't see a disposition fee. So I think that's usually pretty standard. In terms of total returns to limited partners, right? So when I first started investing in 2015, I like to see like double-digit cash on cash, sort of by year two. That really went away probably 17, 18, and went to 7-8% cash on cash. Then it went to 5-6% cash on cash. So it kept coming down. Total return. Most people forecasted, let's say over 5 years. Most people were trying to hit like basically a 2x multiple over 5 years. So that would be like a 20% IRR. Most people were trying to hit that in 2015, 2016. Then it slipped maybe a 70 to 80% total return. So maybe 1.7 on your equity over 5 years. And so that's where I still see it right around there, probably about 70% total return. Which is maybe like a 10 to 15% IRR depending on how long you hold the deal.
Right.
And deals are still getting done at that number.
Right.
And people are still investing, and people are okay. I mean, people are okay at 5-6% cash on cash because your savings account is zero right now.
Yeah, that's right. That's right.
And interest rates on everything else, and
Yeah, for sure. Now, for the GP that's listening to this and they're trying to find limited partners like yourself, like what are they? I mean, what do you think is like the best places for them to go network or go find somebody that would be interested in investing in one of their deals?
I mean, it seems to be different for a lot of people. I would look at your background and figure out sort of what is your existing network. I would start there. And so if you were in the NFL or you were a doctor or you were an engineer, like that's where I've seen people start, is sort of gravitate in their network. If you have no network in that space, then at that point, I would probably start into these investment clubs and meetups and things like that and start there. And then honestly, I mean, I would probably partner with someone who's more experienced on your first deal, because that's gonna separate you. I mean, I would see it as like a huge pack of people who have not done their first deal. And then once you get out of that pack, you've done one deal. I mean, you're doing videos at that property. You're having tours at that properity. You're having people come over, check out your amenity center. You're going to leasing office. You're having a pool party. You're doing all these things at that property. And it's it's a 30-unit deal. This is like the Ritz-Carlton all of a sudden, right? So that first property, even if like you're the general partner, you signed on the loan, you're a loan guarantor, key principal. The other guy who had all the experience, he raised 90% of the equity. You did 10% of the work. I mean, you might get 1% of the deal. But it doesn't matter. Right? Because now, when you call a listing broker in that market and they say, who is this? And he said, oh, this is Will Smith. We got this property down the street from us. We're looking to expand the portfolio. They know that property. Right? And all of a sudden, they answer your call, number one. And they respond to you. They start sending you some deals, and you just repeat that call with every listing broker in that market. Right? And now, especially, I mean, as a listing broker, you understand this, right? When someone calls you and they're like, yep, I'm from California, I want to buy something in North Carolina. And you're like, do you own anything in this market? Nope. Have you been here? Nope. Like, it's just, you know, the level of credibility of somebody who owns already in that market, who lives in that market. Yeah. I mean, it just skyrockets for listing brokers, property management companies. So after that first deal, I think it helps a lot.
Yeah. Yeah. Man, I think that's really good advice. Because so many people get caught up on, I don't want to give up my share, man. I don't want to give up my, but they're thinking too small, man.
You got nothing right now. You got nothing right now. So stop thinking that you're, I mean, at this time, I mean, right now, as a first-time general partner, all you got is time.
Right.
And you don't have experience. So another thing that I like to look at, so when we're putting together that sponsorship team, really there's 4 things, right? So you got to have a deal. You got to have multifamily experience.
Yeah.
You have to have net worth and liquidity. Yeah. And the 4th thing is you got to have equity.
Right.
So those 4 things will get you that first deal.
Yeah.
And when you're first starting, you might have a little bit of net worth and liquidity, and you might have the ability to raise equity. All right. So when you're coming in a deal and they got 20% equity to chop up.
Yep.
You're not getting half that equity on your first deal, right? Because you don't have the deal and you don't have multifamily experience. Right. And those 2 things are the most important things. So you have the 3rd and 4th thing, right? Which are good. You have the net worth and liquidity, and you have the ability to raise equity. So you have to convince somebody with multifamily experience and with the deal to sign on the deal with you. Yeah. And once you sign on the deal, all of a sudden you've added multifamily experience to your resume. So now you got 3 things.
Right.
And now you can go out there and start trying to find deals. And then once you have that 4th thing, you really don't need anybody else, but you might help someone who only has net worth and liquidity and raise equity, and the cycle starts again. It just keeps going on and on. Yep.
Yeah. No, that's pretty awesome, man. I appreciate you sharing that. I'm sure my listeners got a lot out of that. Let's go ahead and transition to the last segment of the show, the lightning round. 5 quick questions for you.
All right.
All right. First one. What's the best advice you ever been given?
Oh man. The most recent advice that has sort of stuck with me is, I think I heard it on a podcast with Naval Ravikant, and I think he stole it from Scott Adams, who was the creator of Dilbert.
Yep.
And he said, instead of trying to be like the top 1% in a area, be the top 10% in like 3 different areas. And he called it skill stacking.
Yeah.
And so the way I think about it in my life is, all right, I was pretty good at underwriting, let's say top 10% in underwriting, but then I got in the top 10% of multifamily origination. And then I got 3 of those, and that allows you to be a top 1% producer.
Okay, now I missed that last one. I heard the first 2. It froze up on the 3rd one. I got to hear that 3rd one.
Okay, sorry. Start again. So top 10% in, let's say, underwriting.
Yep.
Right? And then that was after 8 years at GE Capital, top 10% in underwriting, right? Because you looked at 1 million transactions. Then the last 5 years, top 10% in loan originations.
Yep.
Right? And then the last probably 2 or 3 years, top 10 in marketing.
Yep.
And you combine all those 3, and there's nobody else that has those skills. There might be someone better than me, absolutely, in underwriting.
Right.
But they have never originated a loan.
Yep.
And there might be someone better in marketing than me. Absolutely. Gary Vee is better than me in marketing.
Right.
But then he hasn't underwritten a loan, multifamily loan. Right. So you stack all those 3 skills together.
Yep.
And you have to look at your specific background and think about, all right, what are the 2 or 3 skills that I am stacking together to be in the top 1%? And I just never thought about it in that direction.
Yeah.
Most of the time people are like, for yourself, how am I going to be the best right tackle? Right.
Yep.
Like, but then, a lot of things, like I'm watching The Last Dance right now on Netflix, and there was one game where essentially Phil Jackson told Michael Jordan, like, look, John Paxson is open every time you drive to the basket.
Yep.
And you are getting hammered every time you drive down the lane. They're just hammering you, and he's just wearing down.
Right.
And then in the fourth quarter, every time he drove to the basket, Jordan just dished it to Paxson. Paxson hit a three over, because it's wide open.
Right.
And so you just have to know sort of what your skills are and sort of adapt to that situation. And so look at your background, figure out what skills that you can stack together, because that's how you become in the top 1%.
Yeah, man, that's some of the best advice I heard on this show, man. That's great. All right, what's the best book you've read in the last 12 months?
I know everyone says, let me look at, so I was at part of a mastermind, and we did like a book a month. And, everyone says Rich Dad Poor Dad, but in the last 12 months, I would say The One Thing by Gary Keller.
Yeah.
And, the question they ask is, what is the one thing that you can do that will make everything else sort of irrelevant or unnecessary? Right. And you keep asking that question over and over again. And sort of you keep going down and down. And so I think that's just a great focusing question. Yeah. And so I would read that book. I'm probably going to read it again because there's so many different examples of how that applies across not only like your business and but also across your life, right? Like, with your family, what is the one thing that you can be doing right now? So it's a great focusing question.
Absolutely. What are some rituals you're doing right now that's making you a better investor or person in general?
In terms of rituals, I mean, I don't know if you've read sort of Hal Elrod's Miracle Morning. Yeah. I think it's usually like a miracle day. It probably takes me all day to get all the things that he wants you to do in the morning. Right. So I've definitely tried to implement that. I usually try to work out in the morning, just sort of knock that out. And then I think, like, I don't really have a great journaling practice, but I just save notes on my phone. Right. And so whenever I see anything, I'll snapshot it or put it in the note file. And then whenever, like, a lot of times I'll be on like an airplane, or used to be on an airplane. And I'll just go to my notes. I'll just go to like the last file that I haven't looked at in 3 years and sort of read what I was thinking about like way back then. And I think that's a good practice. I would say those two. I mean, I think one of the things, I mean, I can't remember where I saw this, but just like, have you read anything about like the Blue Zones?
No, I haven't.
Familiar with Blue Zones? So there's a guy named Dan Buettner, and he essentially went to like 5 to 10 areas with National Geographic, and in these Blue Zones, essentially where people live to 100. Wow. And he followed them and for years. And, there was all these habits that they created. And one of them was just sort of like moving frequently throughout the day. And so like my wife and I will walk at least once or twice a day just around our neighborhood, which goes probably about 45 minutes. And so that practice of doing that has really helped just physically, but then also just sort of connecting and, without the kids, screaming at us. I got 3 boys. I think you have 4 kids, right? Like, yeah. 4 girls. So I got 3. You have 4 girls. So I'm trying to balance you out. I got 3 boys, but like that's one of those things that, sort of getting out of the house and just connecting. And then walking is very different than like if we go to a restaurant and we just sit and staring at each other. Yeah, it's very different when you're walking. Like I just process different things, and you're thinking about different things. So those would be a couple things.
No, that's awesome. That's awesome. What is one thing you're doing right now that help you improve your business?
I mean, right now I would say my new hobby sort of post COVID has been YouTube.
Okay.
And so I posted a video on YouTube, just sort of multifamily finance 101, like 3 years ago.
Right.
And it was, I mean, I sent it, I think I sent it out on one email.
Yep.
And maybe 100, 200 people watched it that day. And it just sort of sat on YouTube.
Yeah.
Right. And then over time, if you type in like multifamily finance, it definitely comes up.
Oh,
but
yeah.
if you type in like multifamily investing or multifamily real estate, whatever, it's like one of those recommended ones that is right there. So I was like, all right, let me try this out. So I started making stuff on YouTube, and a lot of the things that we talked about today, if you see a chart, like I tried to describe it visually, but if you see the chart on YouTube, it's a lot easier. Right. And so I just sort of have taken on this like YouTube personality and just started putting a lot more stuff on YouTube. And what I found is that it is searchable. And now I try to use YouTube as, that's my like go-to. Like I can't like, besides The Last Dance on Netflix, I almost try to watch everything on YouTube just because it's so customizable. Yeah. And you can hone in on exactly like, this camera versus that camera, or this product versus this product, versus like I go on Hulu and I'm just like, I got nothing. Like I can't invest like 45 minutes in this thing. Like I got like a 5-minute attention span. So.
Yeah.
And I mean, I guess what gave me more confidence is, Robert Kiyosaki, he said the best teachers are on YouTube. Yeah. So if it's good enough for Robert Kiyosaki, it's good enough for me.
Absolutely, man. No, that's a great tip. Great tip. All right, last question for you, man. If you can give your younger self one tip in regards to investing, what would that be?
Get started. I'm trying. What is one tip? My younger self. To me, I think it's about surrounding yourself with people, that you want to be like.
Right.
And so as soon as, like, if you're in a job and you look at the people who are ahead of you and you don't want that position, then you're pretty much in a dead end and you need to find something else to do.
Right.
And so I think, there was a quote that I read in a book, and I can't remember the book. But it basically said every decision in life should take you from a laborer to a capitalist. And so you have to do something in your job to either build skills and relationships or capital. Because at some point, you're going to need those skills and relationship. At some point, you're going to need that capital to invest in deals.
Yeah.
And once you do that, then that's how you move from a laborer to a capitalist. Yeah. And so I would tell my younger self, because a lot of people, like when you're 20 or you're coming out of school, you're coming out of college, you're coming out of NFL, you're coming out of all these things. Yeah. A lot of times you don't have the skills and relationships and you don't have the capital.
Right.
And so you have to do stuff that are going to build those things.
Yep.
Right. So when I came out of GE, I had capital, but I had no skills and relationships. So I had to build skills and relationships, and then I built capital along the way, but I was working the whole way.
Yep.
Right. So it wasn't like people think that, I can do all these things, but you have to at least have somewhat of a calling card. Like you have to have something that people remember you by, and something that you do. Some way that you're providing value. Right. And so that's, to my younger self, that's what I would try to figure out is, what are you going to do that's going to provide value? Because when I was at GE, my value was really for my manager, right? Yeah. I'd underwrite the deal. I put it on my manager's desk. So I was helping like one guy.
Right.
Right. But now as a mortgage broker, I probably just during this interview, I probably got 20 emails of investors sending me emails saying, hey, what do you think about this deal? What do you think about this deal? Can you finance this deal? That type of stuff. So now all of a sudden I'm helping hundreds of people.
Right.
And then, you put something on YouTube and in the first day there's 500 views. All of a sudden you've helped 500 people
Right.
Learn about a subject, and you've gone from helping one person to helping a couple hundred to helping thousands.
Right.
And so the more value that you can provide out there in the marketplace, and obviously at some point you have to charge for something.
Yep.
So understand what you give away for free, but understand what you charge for.
Right.
And so we give a lot of educational stuff away. We give a lot of content away for free. We help people along the way. But then, if we help you get to the finish line, we help you get to your deal, we charge you a loan origination fee.
Right.
And some people don't want to pay us still after all that. So that's what we charge for. That's what we do.
Right.
But I think that would be my advice, is sort of figure out what value you're going to provide to people and figure out a way to charge for it. So, there's I don't know if you've heard of this. There's a Japanese saying. It's called Ikigai. Have you heard of Ikigai?
Mm.
Okay. So Ikigai, you can Google it later. Yeah. Ikigai is essentially like the center, and it's the center of like 3 or 4 different things. I can't remember it exactly, but it's essentially just like, what the world will pay for, what you're passionate about, what you're good at. A combination of all those 3 or 4 things is your Ikigai. And that's why, going back to the blue zones, that is why people in those areas really never retire.
Right.
Like, they might have enough money, but they're good at the thing that they do. And that is why they get up. And that's why they live to 90. They live to 100, right? Because every day they have that motivation, that drive.
Right. No, that's good, man. I appreciate you sharing all that wisdom. Now tell my listeners, man, how can they get in touch with you if they want to learn more about what you do at Old Capital? Yeah,
I mean, I'll give you my phone number, 214-330-5035. That's the phone number. My company website, oldcapitallending.com. We have a podcast, oldcapitalpodcast.com. My YouTube channel, just go youtube.com/James Eng. You'll find it there. Every deal that I've closed is listed on my personal website, just txmultifamily.com, has all that. That's it. I mean, that's it. Reach out to me, phone, email, website, either way. And, happy to help anybody who is, doing their first multifamily deal to their 10th multifamily deal.
Awesome, man. I appreciate you coming on the show today.
All right. Thanks a lot, Will.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.